A very good afternoon, a very good morning. Welcome to HYCM's workshop with myself, Giles Coghlan. Looking forward to getting us ready for the main event of the day, which is the FOMC meeting. In fact, the main event of the week, possibly the month. So I'm really glad you could join me. Special welcome, Charles, Eddie, Yaz, Ignatius, good to see you. Yaban, Marco, Philip, Suraj, you, great to have you here. Now, as folks are coming on, don't forget, as we talk through different outlines, outlooks, this is from a trading educational perspective. It's not a signal trading service as we go to outline what we're expecting and looking forward to getting us through for trading the FOMC tonight. I was speaking to Bloomberg Ashrak, if you're Dubai based or an Arabic speaker, later just about 5:30 UK time ahead of the FOMC, and looking forward to explaining what's going on there. But you guys and girls have the early edition, and I'm going to be explaining to you exactly what I'm looking for today. We'll also cover the Bank of Japan meeting because that's meeting overnight, and if we get time we may have a quick look into the Bank of England. Don't forget, you've got the chat function. If there's anything you don't understand or unclear of, please message me. The only question that's a stupid question in my book is the question that's not asked, so don't be in doubt. Instead, have confidence and feel free to ask away any question that you may have. Now, what I want to show you is, first of all, I want to get us into the big picture. It's very important, like trading as in life, to be aware of the big narrative. Now, if we see what happened here, can you see the major indices here? But the S&P 500, the Dow, the Nasdaq, the DAX, Euro stocks, right? If you look at them all, can you notice how they fell sharply lower on this single candle here? There was like a 3, nearly a 5.5, nearly 6% drop in the Nasdaq on the high inflation print that we had from the US on Tuesday, 13th September. Now, if I just quickly go through to the 13th September data, you'll see but it was this print here which spooked markets. You see how the headline inflation came in at 8.3%, in line with the high expectation and above the forecast, and the core came in above expectations for the forecast and in line with the high. So what happened is investors thought, oh no, we thought that inflation was falling, and we thought that the Fed would need to be less aggressive. However, that strong inflationary print meant that equity traders got worried. And you see how equity markets were gaining on expectations of a Federal Reserve that were going to be less aggressive. All those gains were suddenly erased in one day. Because what was happening there is that markets were thinking, okay, we need to be worried here, the Fed's going to be more aggressive. So since then, that's why we've seen equity markets falling down. We've also seen commodities pressured lower, silver and gold pressured lower in line with the strong dollar. We've seen bond yields push up higher across the world, in fact. And if you look at the major currency pairs, the dollar index has just been gaining steadily. And you can see here, this was the candle from the 13th of September down here in the bottom right. So what's going on is investors are fearing that the Federal Reserve is going to need to be more aggressive going forward. So how can we best take advantage of this? Here is a outlook, very nicely put by the Financial Source team. You can see they put this up on their Twitter feed, and this is a really good tool for us to use today. And it just shows you exactly what to expect and what's the bullish, the bearish outlook. So let's first of all look, what's the baseline? What's expected? Well, it's now expected that there'll be a 75 basis point hike. And if you just take a look here at short-term interest rate markets, I'll just show you the curve for the Fed. You can see, look, expectations are 100% for a 75 basis point hike. So 100 basis point hike would be a surprise, but what it's going to depend upon, and this has been the case for central banks throughout the world, is it's not the headline that grabs the attention, it's what do they see coming about the future, okay? And you can see here that the median dot plot is currently looking at 4.5% for 2023. So short-term interest rate markets are expecting that to be 4.5% for 2023. Now, that means expectations are as follows. There'll be a 75 basis point hike, but the 2023 median will be 4.375, and the GDP is going to be close to, but slightly greater than 1%. The core inflation will be 4.5% for 2022 and 2.7% at 2023. Okay, and the balance sheet run-up is going to continue at the current rate. There's signs of slowing housing, but encouraged by recent growth in labour data remaining tight. So that is the base case. So if that happens, that's only what the market's been expecting. So what we might see in that environment is the dollar selling off, and we might see a bit of relief in equity market, a buy the rumor, sell the fact response, and you'd expect to find maybe upside in pound US dollar, upside euro US dollar, downside in 10-year yields should push the dollar yen lower, lift the Nasdaq, the Dow, the S&P 500, and also lift precious metals, gold and silver. But that, for me, I wouldn't be trading that. I want to see a dovish or a bullish reaction to trade. Now, this is a slight caveat. If we got a 75 basis point hike, but say the dot plot comes in at 4.5%, or say the dot plot comes in for a 5% dot plot for 2023, that would be very hawkish. So if we got 75 basis point hike and a dot plot coming in for 2023 at 4.5% or greater, say it's 5% would be ideal, then we expect upside in the dollar. So then you trade dollar yen upside. You'd expect 10-year yields to gain. You expect another leg lower in the S&P 500, the Dow, the Nasdaq, and you'd expect gold and silver to have another leg lower. Okay, so bear that in mind. So it's not the headline that is the major focus. It's what do the Fed see coming further down the line. Now, a very dovish reaction would be if it's a 50 basis point hike and they project the 2023 median dot plot to be around 4.12%, and GDP seem to be less than 1%. Core PCE is seen to be less than 4.3, and the 2023 2.7. So if they see inflation going, they think they need to be less aggressive, and they project slightly lower interest rates for the 2023. If we saw all that, that would be very dovish, and that would be a great opportunity to go long gold and silver. I prefer silver longs to gold because of the high gold silver price ratio at the moment. So in this case, if it's a 50 hike and the dot plot is looking at a 4.125% median, I'd expect upside in silver, gold, S&P 500, Nasdaq, Dow, downside in the dollar, downside in 10-year yields, and so I'd short dollar yen, long the S&P 500, long silver. That's what I would personally be doing in that scenario. This is a very unlikely scenario, so it means if it did happen, it would be very, very significant. Now, the 100 basis point hike is very interesting too. If we got a 100 basis point hike, don't focus on the headline, look at the dot plot. If the dot plot is moving up towards 5%, okay, for 2023, and you've got 100 basis points and the Fed is, really getting tough on inflation, I expect another leg higher in the dollar. I trade the dollar yen upside, but be careful of the Bank of Japan intervention overnight. So it wouldn't be one I'd hold overnight. Cover the Bank of Japan in a minute. I expect S&P 500, Dow, DAX, another downside leg, and I'd expect downside in gold and silver. So this is what I'm looking for, and I will be trading short-term moves. Okay. So just like yesterday, I traded a short-term move, and I'll just share this with you for your education. Please excuse me. If you look at yesterday, there's very low Canadian CPI print, and for a while, I've been saying that if we got a miss here in the CPI data, that would be the best opportunity because we expect CAD weakness. you just take a look at the CAD index. If you look here, I'll just show you that. You see how the Canadian dollar has been gaining and gaining and gaining over the last few weeks and months. You know, it's been very high. The Bank of Canada continually given more optimistic upgrades for Canada's economy. They hiked by a surprise 100 basis points in July, and the CAD's just been gaining. So any bad news, or not bad news, but any sense that the Bank of Canada wanted to be less aggressive was looking for that to weaken the CAD. And low inflation was reason. And with the aggressive expectations of the Federal Reserve hiking by so much, then it made sense to go long the dollar CAD. I went long the dollar CAD at 1.3300 and just took profit at that 1.3350 region. Just 50 points, but it was enough. And as obviously heading into the FOMC decision made sense. Now, we also want to look at what's going on with the Bank of Japan. Now, the best pair in my mind for trading the Bank of Japan decision before the Federal Reserve, if the Fed were very, very dovish, then I'd trade the dollar yen across the Bank of Japan. But this is the problem that Japan has. I've written about this in a number of different places and spoken to some media outlets about this. Look at the yen. Look at it from a big picture perspective, not that big. Let's just go down. Do you see how the yen has been falling so heavily this year? Since the start of the year, the yen just weaker and weaker and weaker. Why? Because the Bank of Japan has very low interest rates, and they've been pegging their Japanese government bond, JGBs, at 0.25%. They have said that they want to keep the JGBs within this band between plus 0.25 and minus 0.5. You can see I've got it marked on the chart. So whereas bond yields have been surging, if you look at the bond yields of like the US, you can see the US bond yields 3.5, German 1.8, Canada 3%, New Zealand 4%, UK gilts 3.3%, Aussie bonds 3.7%. But look at Japan, 0.25%, because the Bank of Japan has been buying bonds at unlimited levels to keep the yield capped. So it's stopping that sell-off in bond market that's happening around the world by artificially buying Japanese bonds. That helps keep the Japanese yen weak, right? Now, the weakness has become a problem. So the Bank of Japan meet after the Federal Reserve, and what they want to see is the yen strengthen. But they can't at the moment see the yen strengthen because part of the yen's weakness is the surge higher in 10-year yields. You can see here, this is the blue chart, and you see how these interest rate differentials between US and Japan keep the yen weak. So this means that the Bank of Japan is under real pressure. What do? There is a chance that they either remove that band on the JGBs, or they hike interest rates, or they give some explicit direction to markets about how they're going to strengthen the yen. The problem that central banks have is it's very, very hard to intervene in currencies. The Swiss National Bank tried it in 2000, right, and 11, 12, 13. They held the euro Swiss franc peg at 1.2, but eventually they capitulated January 2015. They failed. Japan tried to keep the yen stronger in the 80s. They failed. The RBNZ tried to intervene in their currency market. They abandoned the project. The People's Bank of China were mooted to be considering pegging the US dollar Chinese yuan around that 7 level. They decided wisely, in my book, against it. So the problem is central banks have got a very poor track record of intervening against currencies. But if they do, you'd expect the yen to strengthen. An obvious pair to trade would be the euro yen. Look how strong the euro is against the little old yen. And we know that the Eurozone is in a sort of semi-war footing. Russia's mobilizing troops, 300,000 reservists being called up today to support the war effort in Russia and Ukraine. And as a consequence, the euro yen could easily fall if the Bank of Japan intervened in markets overnight. So look at that. Okay, that's the things to look at. We then have the Bank of England. Now, Charles has asked the question, what is the real BoE mindset re cross currents? Now, I have written a piece on my blog. If you're not following my blog, make sure that every week you're going to my blog and you're looking, and this is, 95% of the material here is written directly by me. Okay, and I've got the Central Bank Watch, and I've got an article here, Charles, what to look for from the Bank of England meeting, and I outline that there. So I'm just gonna, sometimes this is a bit, there we go. Right, I've sent the article out. So what you're looking at here is this is the expectations of the Bank of England meeting. Now, it's quite tricky. And the tricky thing is if they get very aggressive on rates, the market could take that as negative. So you have to read my explanation here with a pinch of salt, because this is quite a hard decision from the Bank of England. And I'll explain why. Because if they become very aggressive at hiking interest rates, normally that would support the pound. So if they hike by 75 basis points, confirm a higher rate than 4.5% in the terminal rate, start quantitative tightening, you expect that to be pound bullish. But if the market looks at that and says the Bank of England is getting too aggressive and it's going to bring the UK into a hard recession with stagflationary fears, then you can see the pound fall. So this is just a tentative outlook for the Bank of England meeting, okay? The best opportunity will come from a very dovish response. So if they only hike by 50 basis points, push back against the 4.50 terminal rate, postpone quantitative tightening, that would be negative for the pound. Exactly how the pound's going to react at this Bank of England meeting is tough. And remember, part of the pound's weakness at the moment has been the dollar strength. So the dollar strength has weakened the pound, the Russian-Ukraine crisis has weakened the pound, and the fact that the Bank of England projected a recession for 5 quarters in the last central bank meeting has weakened the pound. So there's an enormous number of factors that are really heavily influencing the pound right now. But a lot of bad news is priced in, Charles. So any kind of good news, anything that's optimistic, anything that isn't as bad as the market was expecting, you could easily see the pound rally. So that's roughly what I'm looking at. But it's one of the trickiest central bank meetings to call, Charles, and not as straightforward as it is with the Federal Reserve, for sure. Charles raises a good point here. He says it'll be very hard to immediately absorb unexpected result, then enter a good price. It's not as hard as you think, Charles, because you tend to get opportunities to run to at least the next pivot points. It's a bit like yesterday with that dollar CAD. Okay, I entered in about 1.3002, and look, you do get a run to that next pivot point. I took profit at that 133.50. My ultimate target would have been that R2 pivot point, but I took profit early. Didn't want to wait to the end of the day. Just took the profit and ran. But usually you will get a move at least from one pivot zone to the next. So that's what I'd say, Charles. And you can always wait for slight pullback. You tend to get this kind of, when the data releases, you get a shift higher, then lower, then shift and higher, and usually you get opportunities to enter. And if the data is quite important, you will tend to see a considered shift in the move that happens over the course of a few hours. Yeah. So usually you do get opportunity, Charles. Charles says UK soggy data has not really been published yet. No matter what, short any real rally. The problem with the pound, and the reason I'm not confident to do that, is if you take a look at the pound, what you see is that a lot of the bad news for the pound, has been heavily priced in, right? And if you look here on the daily chart, this is the pound index, you can just see that the pound has been heavily sold off. Now, if you think back since that August meeting, that was when I thought, look, there's really good opportunities to short the pound going back to the middle of August, Charles. Now we've had, like, you know, basically over a month of bad UK data, strong dollar. We've had a series of negative data points coming from the UK, the energy crisis, the cost of living crisis, all of it's been weighing on pound sentiment. So would I feel confident to short any rally? Look, if the pound index moved up to about 107, 110, I would be with you, Charles. But as it is, we're right at the bottom of recent levels. So I would feel much happier personally buying the pound on good news than I would on continuing to sell the pound. It's looking quite stretched. So that's my concern with that. Okay, folks. So if you missed the first part of the webinar, don't forget I'm using this very helpful cheat sheet from Financial Source, which just gives a good outline of what to expect from the Federal Reserve. Remember, don't just focus on the headline. You want to see what the dot plot is saying, because the dot plot will show us how aggressive or otherwise the Federal Reserve will be. And central banks at the moment, whether they're hiking by 75 or 100 or 50 basis points, it's not as important as what they're going to do in the future. So remember, the headline interest rate is one thing, but the dot plot, in other words, what are their future expectations? That's what's going to be important. And looking at, you know, the expectations, if the median dot plot comes in greater than 4.875%, you know, if it's up towards 5%, but they've hiked by 75%, that would be bullish. So it would be dollar buying, dollar yen upside, S&P 500 selling, gold, silver selling. Okay, that would be the clear and obvious opportunity. The best dovish opportunity, 50 basis point hike, but it could be a 75 basis point hike, but if you've got a lower dot plot. So if the dot plot's coming in like 4.12 or below 4, then you expect dollar downside. That would be a great trade for pound US dollar upside, Charles, because the pound's heavily sold off, so any weakness in the dollar will be expressed quite nicely against the pound. Pound US dollar upside, we've got the mini budget coming on Friday for the UK. That should be a bit of fiscal stimulus, should boost the pound. We've also got 10-year yields, so you expect dollar yen to fall lower, and you expect upside in the S&P 500, NASDAQ Dow, and upside in gold. Silver will be my preferred precious metal to trade in the instance of a dovish surprise. Folks, fantastic. Should be a great opportunity. Really looking forward to it. Yes, Philip raises an excellent point. And this is why it's so hard to call this Bank of England decision. Very wise, sensible observation. So what Philip has just said, and it's a great point, is why is the 10-year yields rising, right? But the pound is not reacting to it. So let's just show you that by overlaying it on the pound index, right? And there's a really good learning point here. And good man, Philip, you identified the right thing, right? Okay, generally speaking, right, when you see 10-year yields rising, that's generally supportive for a currency. Okay, they normally move in tandem. Okay, rising yields, rising pound, falling yields, falling pound. You see how the pound and the 10-year yields tends to move in synchronization, right? That's the normal reaction of yields and the currency. Bond traders are concerned about interest rates just like currency traders. So that's why currency traders look at yields. Now, what are we seeing? Aha, we're seeing 10-year yields rising, but the pound falling. Why? It's because of distress, Philip. So one of the other reasons why bond yields rise is when bonds are saying, look, we are offering you a higher yield to attract investment because we're in a state of distress. So when yields rise, but the currency falls, it's a symptom of currency distress. And the pound is in distress, Partly it's the Russian-Ukraine crisis, euro and the pound both hammered lower on when that crisis started. Partly it's the dollar strength. Partly it's uncertainty about Brexit. Partly it's uncertainty about Liz Truss's economic plan. Partly it's cost of high energy, how that's going to impact UK consumers and UK businesses. All of that has resulted in a disconnect between yields and the pound, which is why I said why I'm a little bit nervous about sort of, having a clear outline of what how the Bank of England would expect. Because even if rates are expected to go higher and yields push up, you could still see the pound fall for that reason. Because if you think about it, what a yield is offering you is a kind of, when a country's in a distress, like when we saw the Italian crisis going back a few years, we saw the Italian Bund offer huge yields as the euro was sinking because it was under distress. In other words, bonds were saying, like, we're going to give you 10% if you can hold an Italian bond, because the risk is that Italy could have defaulted, maybe it left the eurozone, it's more negative. Does that help, Philip? So look at that. Yeah, Charles, you're right. There are funds flowing out of the UK, but I think there's also an element of distress as well. Yeah, Philip, does that help? Look for it because it happens all the time. And in fact, the bond that you'll see always spoken about is called the BTP Bund spread, right? So when the BTP Bund spread rises, it's a sign of distress in the euro. Okay, so rising BT Bund spread, falling euro. See here, there's the European sovereign debt crisis. Rising BTP Bund spread, falling euro. Rising BTP Bund spread, falling euro. It's a general rule. Okay. Yeah, Philip. It's not something like it's not something you really react to like that, Philip. Do you know what I mean? It's not like, aha, the bond yield spread is moving higher, therefore I'll sell the currency. It's not quite like that. It doesn't quite work like that. It helps you to form a picture, and it's a one kind of like tool of your analysis. But I don't know of any traders that would be using it, solely for your trading. You know what I mean? It just forms part of the analytical background. Yeah, ZAR can be vulnerable to continued dollar strength, Charles, and that will come from what the Fed say. Emerging market currencies will tend to get hammered if it's a more bullish outlook from the Federal Reserve. Folks, Charles, Philip, thank you very much for your questions and your comments. Much appreciated. Philip, thank you. Yasser, good to have you. I am now, one thing I would say is I am due to be in Dubai coming up shortly. And if you're around, it would be great to have you there. I'm just going to send you a link and you can meet me in person. I'll be running a whole day of teaching elements. And I've just sent it to you in the chat. And I'll be talking about how to invest in FX stocks and gold in a high inflation era. I'm going to cover loads of things. So if you are in Dubai, please make sure you come up. Particularly if you've been attending this webinar for a while, it'd be great to see you, some of the regulars. It'd be lovely to have you there and to meet new friends as well as old. So if you can make it, come along. Otherwise, yeah, meet lots of Russians in Dubai. Yeah, I think I probably will actually. Yeah, you're welcome, Philip. I'll let you know, Charles. I'll tell you a funny story. I did see today when I was listening to the UK, they were speaking to a Russian diplomat on the UK national news, BBC Radio 4, and the Russian diplomat was essentially saying that there was a risk of Moscow sending a nuclear bomb to London. Shocking words. And it was just funny that the UK host said, "Thank you very much," at the end of the interview. And I thought, it's only in Britain where people are so polite that someone indicates they may be sending a nuclear weapon to your capital city, and you end the interview by saying, "Thank you very much for attending," as a lesson in British politeness, if ever I've seen one. Folks, thank you all very much. Been a pleasure, and I hope to catch up with you Monday. And yeah, that's it's quite something, Philip. Take care, everyone. Now, goodbye.